Why Tesla might kill the $25,000 model. The profit math Elon won't say. Imagine Tesla building a $25,000 car and then shelving it. Sounds crazy, right? But the truth is messy, and it could change everything about how Tesla and every automaker thinks about cheap EVs. Today on Elux Motors, we break down the real reason Tesla might kill the $25,000 model. Not because they can't build it, but because the numbers say it may not make sense. I've read Tesla's filings, CEO comments, and industry analysis, and I'll separate what's confirmed from what's rumor, so you know whether to believe the hype. 1. The dream versus the math. Short version. Tesla's $25,000 promise was a headline-grabbing milestone, a way to take EVs mass market. But the core problem is simple: profit margin. Car companies don't survive on sticker sales alone. They need a healthy margin to cover development, factories, logistics, and warranty claims. For Tesla, the question isn't can we build a cheap car? It's can we make it profitable. 2. Battery costs change the game. Batteries are the single biggest line item in an EV. Costs fell dramatically over the last few years. BloombergNEF and other industry groups report pack prices in the low hundreds per kilowatt hour. But they're still expensive enough that a small car with a usable range still needs a costly battery pack. Even at $1.15 per kilowatt hour, cutting enough cost to hit a $25,000 retail price while keeping margins is brutal. That's the raw reality. 3. Elon's pivot to robotaxis. Here's the big strategic twist. Elon Musk has repeatedly said that building a $25,000 car for human drivers might be pointless unless the vehicle is autonomous, because the real long-term money is in robotaxi services, not ownership. In plain terms, Tesla might prefer to build fleets of autonomous vehicles for ride-hailing rather than sell millions of cheap cars to private owners. That changes how we think about the $25,000 dream. 4. Internal resistance and production reality. Inside Tesla, executives have reportedly pushed back and questioned the feasibility of the $25,000 program, not just technically but financially. Internal reviews and reporting show the company has had to reevaluate how much of the original plan is realistic versus aspirational. Building a brand new platform and gigafactory lines for a low-cost car is a huge capital bet. 5. New models, new strategy. What Tesla is actually doing. Instead of a radical $25,000 Model 2, Tesla is rolling out more affordable trims of existing models and exploring smaller, more modular platforms, and simultaneously investing in autonomous cybercab concepts that could undercut ownership economics altogether. So rather than a single mass-market model, Tesla might pursue multiple paths to affordability through services, scaled-down trims, and factory efficiencies. Pause 0.6s. 6. The investor and market angle. Why this matters to buyers. 310 to 348. From an investor and buyer perspective, killing the $25,000 car would be a big signal. Higher ASPs, average selling prices, keep margins up, which keeps Wall Street calmer, but it also means fewer truly affordable Teslas. For buyers in the USA, UK, and Australia, that could mean cheaper Tesla options are more likely to come as lower-spec versions of the Model 3/Y or through used markets, not a brand-new mass-market breakthrough. 7. Myth-busting. Common confusions. Quick myth busts. Myth. A $25,000 Tesla is impossible because batteries are fixed price. Not true. Battery costs keep falling, but margins and factory amortization still matter. Confirmed. Battery pack prices have fallen, but not to zero. Myth. Tesla abandoned the idea completely. Also false. The company hasn't declared it dead. Its evolving strategy toward robotaxis and scale production changes.